Are you ready? Are you ready? Because we've got 3 days of very cool stuff lined up for you. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not necessarily indicative of future results. This is training. This is something you will research and make sure that it fits you. So please take notes, write your questions down. Most of the speakers will take questions on the fly, but some do like you to hold until they're done with their presentation. So it is Mr. Rick Bensignor of In the Know Trader. He's going to talk to us about trading with the trend actually hurts your returns. He's a well-known former Morgan Stanley chief market strategist. That's a mouthful. And an expert in the practical application of behavioral finance theory as it directly relates to where and when buy-sell decisions should be made. He was previously a commodities pit trader for several years and the first to have taught behavioral economics and finance theory at NYU. He consults to many of the street's most successful funds and started his In the Know Trader site and products for individual investors 5 years ago to give them access to highly differentiated institutional research that dramatically increases readers' returns. Welcome, Rick. Thank you for joining us.
Well, folks, my name is Rick Bensignor. I'm the founder of In the Know Trader. But here's a little bit about me, and take a look through this as we talk, because what you'll see is that I have over 40 years experience on the street at some of the highest levels of the street and some of the biggest positions on the street. But part of what makes what I do different than most is a few things. One is I have a significant trading background. The first dozen years out of college, I spent trading on the floors of 3 different New York futures exchanges. And I can tell you that the experience that you get when you trade in the pit is incomparable to any other type of education you can get, as far as not just the mechanics of trading, but the psychology of trading, why two people who stand next to each other in the pit can have completely different P&Ls at the end of the year. So much of it is the psychological portion. And my background includes, as Sherry had mentioned, being the first to have taught behavioral finance theory at NYU. The university came to me, I don't know, 15 years ago or so, and asked me to design their whole program. So I did that, plus I taught the core course in it. And understanding behavioral finance theory from an academic point of view only takes you so far unless you really also understand markets and what's behind how and why people make the decisions they do. So this is the background that I come to you with today. And the topic I wanted to talk about, and I'll just go back to the first page here, is why playing with the trend can hurt relative performance to your benchmark. And this is a concept that goes against almost everything that you've been taught. The street focuses on playing with the trend. And we will talk about that in the bulk of what we do. We have lots of slides to get through. Let me just tell you, In the Know Trader was developed to give individual investors access to some of the most sophisticated models on the street used by the most successful firms on the street. And I have multiple products that I print. Put for you a weekly ETF Tactical Trader report, which comes out Thursdays, goes through the bond market, credit spreads, the dollar, gold, oil, anything that can affect the US stock market, I cover with very specific ideas of what to expect in the short and medium term. Then I do a deep dive into the S&P to tell you what I think about it short and medium term, and then give you a brand new ETF trading idea each week, as well as walk you through every open trade we have. I have a 7-11 monthly Spider sector report. The goal of this report is to outperform the S&P. Very few people over time outperform the S&P. This year, we're only up by 43 bips, nothing special. Last year, we outperformed by over 6%. And since I started this 34 months ago, it's outperforming by 13.58 percentage points. That is huge. You will be hard pressed to find somebody who is up that much against the S&P when their benchmark and their investments are pure S&P only and is 100% invested 100% of the time. As Sherry said, a way to reach me is through my email, rick@inthenotrader.com. So we're all taught that the trend is your friend, and you look at a long-term chart of the S&P, and certainly it heads higher over time. Let's, however, start dissecting a little bit this concept of the trend is your friend. Let's go back to the bottom in 2009. This is after the great financial crisis, March of 2009. In fact, it was March 10th. The ultimate bottom was made, and this is priced since. So if you start looking at the trend that was made off of that, and I draw a trend line, at some point in kind of fourth quarter 2009, that trend got broken, or at least the trend line got broken. All right, sold off. We draw another trend line. We make a new higher high. So now you have higher highs and higher lows. That's a new established trend, except that also breaks in 2010 to now get a third time that I'm going to draw a line. And then ultimately in 2011, that trend breaks. So the trend is your friend, but sometimes it looks like it's not so good. Once we get to 2011, I take the major low and I start, again, major uptrend line takes you to the middle of 2012, but then that breaks. So just as you're, let's say, buying into strength as you make new highs and adding more longs, again, the uptrend line breaks. And then you finally, you get probably what ends up being the best 2.5, 3 year run that you're going to get in far as pure trend. Holding trend line. Here you break in 2014, so I'm just drawing. It actually comes up against the prior trend line, so that was good. Bounces, turns around, gets new highs, and these are all-time highs. And then, of course, you break again in 2015. And then you break even lower. So now you can have downtrend, lower highs, lower lows. Eventually this bottoms, so I'll move to the next chart. And what I'm doing is now taking that 2016 low. And again, you get a good 2-year run to almost 3-year run before it breaks. It eventually comes back, then breaks hard in 2020. And then we have to start the process all over again. So we start building trend lines now from the 2020 low. The sharpest angle one eventually breaks, but then the market still goes higher. The second one, we take off of the 2022 early bottom, and you say, okay, well, this is moving higher, except that breaks. So then we do another trend line, and that breaks. In fact, you go into a full downtrend, lower highs, lower lows. So I can even go a step ahead, now start building down trend lines off of that, but those eventually break higher, but then it breaks lower. All mishmash. And now we have, of course, the uptrend lines off of the low. The point is the trend is your friend if you can identify it, if you can stay with it, and if you can actually figure out when the trend is going to change, because otherwise, ultimately, you get your rear end handed to you trying to play with the trend. So this already suggests, just simply looking at the S&P and doing nothing more than drawing trend lines, that a lot of times these trends that we see and they're breaking, and as an investor, you don't know if you should be selling when the uptrend line breaks, looking for prior support to add more. It becomes a much more confusing game than meets the eye of what you're taught as the trend is your friend. So let's take a look at NVIDIA. And this was, I think I put this chart in here yesterday or so, so price is going to be awfully similar. And obviously we had a huge run up recently. So this bottomed in October, but over the last few weeks, massive rally. And here's the question I pose to you. If you buy NVIDIA now in this $380, $400 neighborhood, where is your sell stop properly placed such that if you get stopped out, you have high confidence that the stock is still going lower. If you put your sell stop in a place that you don't have high confidence, actually means that there's good odds that the stock is going to head lower once executed, then you very likely have put your sell stop in at the same place others have been waiting for a pullback to be a buyer. So where would you actually put your sell stop? And let me see, if I want to see if this is something in the chat. Let's open up this chat from with everybody and see if where you would tell me that you would put your sell stop. So for listeners here,
hold that thought for just 1 second, Rick. I'm going to make you
okay,
an organizer so you can see the chat.
sure,
But it
perfect.
knocks your microphone out for about 3 seconds, so just hold on and bear with
Okay.
me. And you're
Okay.
back.
So
All
I'm
right, now
back.
I also want to do one thing before you, I hate to interrupt you, but when you get done,
Mm-hmm.
I want, while you're still on the call and in the room, we want to do the draw for your signed copy of New Thinking and Technical Analysis Trading Models
Sure.
from the Master, okay? So I
Absolutely.
want to remember, now that I've said it, I'll remember, and I'm making a note of it right now. So take it away, and I will be quiet from now on.
And that's okay. All right. So in the chat, tell me, looking at this chart, where would you put your sell stop? If you were to buy NVIDIA now, where do you have high confidence that if your sell stop is executed, you're most likely going to see the stock head lower? So in other words, that it was a good sell stop. I don't see anything in the chat. Let's see. Okay, so I'm not seeing any entries. That's okay, folks.
Okay, so hold on 1 second. What you're going to want to do, the chat is from you to everyone. See the line that says questions? You're going to want to take,
Yep.
see that little
Yep.
box with the little arrow?
Mm-hmm.
Click that and it'll pop out the whole chat. Or not chat, it's the questions box. That's where everyone in the room can ask you questions.
Okay.
And you've got a lot there. Look at this, around
It's
340
interesting.
from Mike.
I don't see anything on.
Mike says
Oh
around
wait, no sound,
340.
no sound. Okay.
Oh, and at the
Oh,
top of that,
yeah.
where it says received, click it so the most recent answer is at the top. So the most recent one for me is stop under the previous bar. You see, you've got X, question, asker, received.
Yes, I see stop under the previous bar. Yeah.
Okay, good deal. All right, now you're getting the most recent answer. So you've got several.
Okay,
Mike
so I
said
see
around 340.
340.
Yeah, there you go. Now you're right on top of where that's at. So
Under 320. Okay, so 320, 340. So the old high was just north of 340 from November of 21. So you would think that if this were now having exploded through that high, if it got back under there, you'd sell. And that's where your stop would be, because you'd have high confidence that this is likely heading lower. I would say to you that there's going to be people looking to buy an uptrend line that would come off of not the lowest low, but let's call it the January low from this year, that are going to be somewhere by the time it gets there in that neighborhood. That's number one. Number two is, would you really buy stock at, let's just call it where is it now? I don't know, 386, 385. Let's use round numbers, 390. Would you pay 390 and risk down to 320 to 340? That's a huge risk on a stock. Now, of course, this is a high beta name, but are you going to really take that much downside exposure on a name and then first sell it, when if you had no position on up here, you probably would much rather be a buyer? These are things that you have to think about when you play the game of trading. Let me close that out now. I'm going to minimize this. Just something I want you to think about. Here's Meta, right? The old Facebook. What about Meta? If you bought Meta now, do you stop yourself out where under, let's say, 240, where these old highs, old lows were, and close to the high in April of 22? Would you actually stop yourself out down here? I'll again suggest that there's going to be plenty of people willing to buy in here if it were to get here. The problem with playing with the trend is that by the time you decide a trend is a solid trend and you first decide to buy, you often are buying at a place that, one, you can't control risk, two, smart money is often selling what you're buying because the basic information that you've been taught to trade with is highly insufficient in actually being able to win the game of outperforming a benchmark. Now, if you're simply a trader and you buy and sell and you make money, that's fine. That's the game. That's what you're supposed to do. But let's say, in theory, you're a portfolio manager, which you really are, even if you're trading your own funds. If you're a portfolio manager, you should think in terms of, is all the trading that I do actually getting me ahead of if I just simply bought the spiders or the QQQ? Am I getting ahead by trading or not? Because if you're not, even though you make money and you buy low and sell high, within, let's say you bought down here and you sold here, you made money, you made nice money. But with all your trading, are you still making more than the market makes as a whole? Because if not, you're actually doing a disservice to yourself. You might as well simply buy the spiders or the Qs or some passive index. So as much fun as you might be having, you're not helping yourself financially. Take a look at this. Here's GLD. This is the gold ETF, the biggest gold ETF. So this has been in a big trading range for a few years. 3 times we got to in actual gold, like COMEX gold, where the futures market, where the price of gold is kind of determined. 3 times we got to 2000 or north of 2000, including most recently, even though GLD didn't do it, the COMEX gold futures on a month ago got to within $5 of its all-time high. So even though GLD didn't, gold futures got awfully close to this high from 2020. But here's GLD, and many of you aren't looking at futures, so let's look at something you are. This is the highly liquid ETF. You had a trend channel that broke down last year. This ended up being a false breakdown. Within 2 weeks of this, we said this is likely, I wrote to all my clients, this is likely a false breakdown. We spent a couple months down here and boom, off to the races to the upside. Now we have this uptrend line. Last week, or actually, I just put this chart in yesterday. I put this slide presentation together. So this is a weekly chart. So this week, we gapped lower, and now we're coming back to the trend line, but it's not Friday yet, but we may very well break this trend line. What do you do if you're long gold? Where do you stop yourself out? I'm staring at an unfilled gap in the middle of the range. Is this going to come all the way back down into the middle of the range? Might it be that this, over the long term, this actually comes all the way back down to the bottom of the range? What do you do if you buy now, or even if you're long? Where do you stop yourself out? And this is a question every investor and trader has to ask themselves constantly. Is this something I still want to hold? And at what point, having essentially a triple top and having failed to break out to the upside, at what point do I come to a determination that maybe this is as good as gold's ever going to get? What happens if this whole pattern ends up being the bigger topping pattern off of years of gold moving higher, going back 10 and 20 years? Remember, in the 1990s, gold was $300 an ounce. Huge difference to where it's now trading at, $19.50 an ounce. So maybe this is a long-term top, and you've had multiple times to get out near what would be the high? These are all questions you have to ask yourself. And the most difficult thing is that when you're buying deep in an uptrend or selling deep in a downtrend, how do you control your risk? And where do you know where you're wrong? So I'm going to walk you through what likely goes through your head most times you trade. We're going to just look at a chart, and I'll talk you through what is likely the noise in your head as you see something. So here's a stock that has a sharp, it goes public back here a few years back in 2019, builds a base, starts moving higher, the hype starts coming in, finally starts to explode, pulls back to the trend line, moves up. Fair to say you're a buyer in here where I have like the letter B. Anywhere in here, you certainly could have bought. It now explodes to new highs. It's all over the press, darling name. Analysts have way higher targets at $200 and $300 a share. You buy some more, and then all of a sudden, boom, you break this major uptrend line. So this goes sideways for a few months after making new highs, and it breaks. So I put an S in here. Let's say you sell some, right? You bought some here, you bought some here. Your midpoint is in here. On an average, you have a small loss. You get out of some. And the same time you get out, later that week, it goes down and actually tests this low and bounces and closes here. But let's say you sold up in here. You go, okay, that's good. But you notice now over the next couple of weeks, it's holding against that. It's kind of bullish. Maybe it comes back up to the trend line. Let's buy some more. So you buy some more. And it moves up, but it doesn't get to where you want. And you're certainly, these longs are trapped in here. And then you go, uh-oh, now it's broken. Head and shoulders top, this thing's going down. So you sell out of everything. So your intent was to play with the trend. You got in what ultimately looks like is towards the end of the trend, which is so common for individual investors. And now you dump out of everything, as you should, based upon this picture. And if you know technical analysis, you'd say that's the head and shoulders. It's going to break. So you dump out of everything, you take your losses, and you lick your wounds. Except where you sold ends up being the bottom. And a few weeks later, it's back up and it's moving high, and you go, darn, I sold the bottom. Now it breaks out above the downtrend line, so you buy. But you say, you know what, I'm only going to buy a half position. I've been burnt on this. I'm only going to buy a half position. So you get long in here, only to see it's break the uptrend line. And now you're thinking, uh-oh, this better hold down in here against prior support because I'm long up here. And you go, oh, thank God. Oh, cool, right? It held just where it needed to. Technical analysis is doing exactly what it should. It told me where support was. We pulled back to the broken downtrend line in pink. It's holding this, what was the prior neckline, to the head and shoulders. Bingo, perfect. Except that rally faded out instantly. And now you're right here against what had been the neckline. And you go, uh-oh, this could be a problem. And then it breaks. Except it breaks and holds the bottom. So you go, all right, it's still holding support. Oh, boy, perfect. Let's buy more. It held exactly where it needed to. I can average my longs. I'm long half a position here. I'm going to buy some more here. We've just come right back above here. Uh-oh, now you go, holy cow, what the heck? All right, so you bought up here, you bought some more here, 2 weeks later, gone. That's this bar. Now it just trades straight down for months. And a few months later, you say, well, what happens to a trade when a trade goes wrong? We're going to call this an investment, right? This is what your head does. It rationalizes that you have bad trades on, and you go, I'll hold this for the long term. So you decide that here in, let's say, the early part of 22, and accept, here's the picture. Come late last year, you say, you convince yourself, well, look, I needed a tax loss anyway. So you dump out of this into year's end so you can get your tax write-off, and this is where the stock's trading now. What do we have? Welcome to Peloton hell. This was a chart of Peloton. The way I described what happened is so often the way most investors play this game. They look to play with the trend, they buy new highs, they sell new lows, and they're often getting themselves completely on the wrong side of many of the trades. So let's spend a little time here now on just a bit of statistics, because when you understand what I'm about to explain to you, you will get a much better understanding that trading in the direction of the trend is almost always a guarantee that you will never beat the S&P. Let's start off. For those of you who ever took a statistics course, this is what would be considered a bell-shaped distribution, a bell curve, of which all the data is in here, and the bulk of the data is on either side of the median or the mean here, and this is called the first standard deviation. So 34% on either side of all the data, which basically means that the first standard deviation of your data will capture 68% of the data points, 34 and 34. So most people will round that out to say the first standard deviation represents about 70% of data. And it is about 70%, more precisely 68.2. And don't confuse that with Fibonacci numbers, which is 61.8. This is 68.2, roughly 68%. That's the first standard deviation. The second standard deviation adds an extra 13.6% to each side, which essentially takes you to about 95% of all your data will fall within 2 standard deviations of the mean. And when you go beyond that, you're into the third standard deviation and so on. But from a pure mathematical point of view, within 2 standard deviations of the mean, you will have 95% of all your data fall into there in a normal bell-shaped curve distribution. What I want you to do is think of this and now flip this chart vertically, which is what I've done here. And if you think about the price of a stock that has traded in a range, let's say mostly from near 40 to 70, back and forth, buyers and sellers, trades in range, and occasionally gets above 70, and occasionally gets below 35 to 40, you can see that the bulk of the trading would be done here. And occasionally, far less percent of the time, you get a move up, down, up into this range or down into this range. But the bulk of all the trading, let's say, gets done in this range. So here's what I'm going to suggest to you. For every time that you're good enough to buy into support near the bottom of the range of where it mostly trades and sell it towards the top end of the range. So in other words, kind of buying near, let's call it 35 to 40 and selling it out near 65 to 70. For every time you're smart enough to buy it down here and sell it here, you're also going to buy what appears to be breakouts in this range that don't end up being breakouts, and then you end up selling it down towards the bottom of the range as it, let's say, takes out the prior recent low, all within the greater trading range. But if you're long at 65 and your stock's trading 45, you're generally looking for a sell stop or somewhere to control risk. And occasionally this is going to shoot up and get to 90 for some reason, and sometimes something will occur and there'll be some bad news and the stock will shoot down to 20 bucks, but generally it trades in here. If you buy here and sell here, as often as you buy here and sell there, you are simply a gerbil on a wheel. You're getting nowhere. The only way to get ahead is to actually buy when you're in the second or third standard deviations of price activity and to sell back near the top end or in the second and third standard deviations on the high side.
Muted by the organizer.
We still good, Sherry? Okay, I'll assume.
Yes, I believe we are.
Okay, I'll assume we're still good. What's the likely reality of your trading? The simple answer is that for every time you buy low and sell high, you'll also likely subsequently buy high and sell low. You cannot get ahead in trading doing this. The models that you have access to aren't designed to do what you actually really want to be doing, which is buying low and selling high. Most models you have access to, the stuff in the public domain, the things you learn from technical analysis, they are not designed to buy low and sell high when you have a predominant trend, or sell high and buy low if the predominant trend was a downtrend. RSI and MACD, those things are fine in a sideways market, but once you have strong, let's use for an example, upward trend, they're going to only hurt you. Here's a recent article from January of this year. This is excerpted from the S&P Dow Jones Indices Research Report. So this is not something I wrote. This is a published article from the people at S&P. Going back over time, they found, so traditionally I will tell you that it was always said on Wall Street that about 6 out of 7 portfolio managers cannot outperform their benchmark. Only about 1 in 7 could. And your goal as an investor was to try to find that portfolio manager running a mutual fund who could outperform. And by the time the statistics showed that this person would outperform over a few years, such that he or she then gathered way more assets because the crowd was now following them, their ability to outperform dramatically dropped and they wouldn't outperform. So you actually, by the time you decided that this was a good portfolio manager to be with and you moved your money there, it was generally a short amount of time before they couldn't and didn't outperform any longer. So then you would go chase after the next hottest person. This is kind of like if you think about people, getting into Kathy Wood's type funds, and she was a darling for years, and then, disaster since, let's call it second half of 2021. 2% of actively managed large cap core funds beat the S&P over time. That's incredible. So what's the likelihood as an individual trader that your portfolio is going to beat the S&P when 98% of professionals can't beat the S&P? So if that's the case, how is it that I'm beating the S&P by over 13.5 percentage points in almost 3 years now? At the end of July, it'll be 3 years. So what's 13.58 percentage points mean to you in actuality? If you had a $100,000 account that you put into Spiders, or a $100,000 account that you put it into my 7-Eleven report, which comes out monthly, you would have an extra $13,580 in your account as compared to where the S&P has risen since August 1st, 2020. I told you before, the 7-Eleven report is a monthly report that picks no more than 7 of the 11 Spider macro sector ETFs to be in. There are 11 macro sectors to the market: technology, financials, energy, communication services, real estate, healthcare, consumer discretionary, etc. 11 different sectors, 11 different Spider ETFs like XLK, XLE, XLV, XLF, etc. If you had each one of these ETFs in the proper weighting that that sector represents to the S&P 500's calculation, you would get the return of the S&P 500. Or of course, you could just buy a Spider, which automatically does it for you. What I'm telling you is in the last 34 months since I started this 7-Eleven report, which is available by subscription on inthenotrader.com, we are ahead of the S&P on a $100,000 account by $13,580. That's not that you're up $13,580. So I'm not saying your account's at 113. It has an extra 13,580 compared to if you had been in the S&P. So what do I do differently than 98% of the street? If only 2% outperform, what am I doing differently? Because you clearly have to do something different than what the bulk of people are doing, to what 2 standard deviations of people are doing. First off, I combine the very best fundamental quantitative behavioral, market timing, and technical indicators out there. A lot of portfolio managers have access to some, very few have access to all of them. Secondly, I have 40 years of experience on the buy side. Now, for those of you who don't know, the buy side is the money management side of Wall Street. So like mutual fund companies are on the buy side, hedge funds are on the buy side. These are portfolio managers who manage other people's money and charge a fee to do it. What's the sell side? The sell side are the Wall Street firms that are like the brokerage firms who put out research and have investment banks. So a Goldman Sachs, a Morgan Stanley, a Merrill Lynch, a UBS, those are sell side firms. So I have extensive background being a portfolio manager myself. So I understand the markets from being a portfolio manager. It's an extremely different perspective than if you're on the sell side, working at a research firm, working at a brokerage firm who has these buy-side people as their clients who are trying to get them to trade through their firms. That's what the salespeople do, and putting out research to entice them to use that firm's investment bank, trading desks, etc. I also, as I started off this whole conversation, I have 12 years experience trading on the floor of the commodities exchange in the pits. And I traded stock index futures, COMEX gold, COMEX silver. I traded cocoa and I traded sugar. So I have an extensive background, and that background is one of the biggest advantages I have to other people on the street. How many people do you know actually traded on the floor and then made a very high level career on Wall Street? Most floor traders end up working for themselves. They don't work for major firms, and if they do, they stay on the floor. They never kind of go corporate. I went from the floor and I was able to get a job in Morgan Stanley in their commodities department. And that started a whole off the floor career that ultimately had me become Morgan Stanley's chief market strategist. Secondly, what do I do differently? I think and act differently to how virtually everyone is taught to play this game. We're all taught to play the trend, enjoy the trend, ride the trend. And what I can tell you is that almost every decision I make is a counter trend decision that is timed effectively to actually be selling when the last buyers are showing up, and then that uptrend exhausts itself. And by the time everybody else in the public realizes, and professionals, that the trend has exhausted itself, you're often 15 to 20% off of that high before people will say, oh, darn, that was the high. I buy stuff that nobody wants to buy, that's been just continuously beaten down. And I try to find the places where the combination of quantitative behavioral timing models suggest that essentially the last seller has sold. There's no one else left to sell. Everybody who's wanted to sell has already sold. Now, I can tell you it's a much more difficult game playing this way, but it's also based on proof, and the proof is in the pudding because my results say I'm one of those 2% who actually beats the market. And the reason I can beat the market is because I have ways to determine when and where to buy a beaten down stock and when and where to get out of a stock that's flying. Number three, the models, and this is what I'm alluding to, that I use are designed to buy low and sell high. Your models that most people have access to that are in the technical analysis books that exist in the general public domain are not meant to buy low and sell high. They buy high and they look to sell even higher, or they sell low and hope to buy lower than where they sell. And I can tell you, and it's statistically proven, it is virtually impossible to beat a benchmark when you do that. The only way to consistently beat a benchmark is to buy low and sell high. Lastly, I understand the behavioral finance theory and far better than most people do. And I do not know of even 5 people on Wall Street who have ever figured out how to actually take behavioral finance theory, which is a very academic and theoretical approach to understanding the human financial decision-making process, and take those concepts and actually apply them to trading the markets. That's the big edge I have. So let me show you just one particular model of many I use that help me look for counter trend or price exhaustion signals. Here's what I do. I look for important prior highs, lows, and inflection points. So that here, that's the first thing I'm going to do is I'm going to look at before I buy a stock, and let's say it looks like it's breaking out upside on a daily chart. I'm going to look at a weekly and a monthly chart first to get an idea of where are prior highs and lows of significance on this chart that may not show up on my daily chart because my daily chart doesn't go back enough in time to actually see that I may be buying up against what was a major breakdown point in the past. So you've got to first take a look at where I am in relation to history, not just over the last 2 months, but maybe over the last 2 years or 10 years. I've got to have some sense of where prior highs and lows of significance, as well as, let's say, prior breakdown points that then became resistance and what would be considered an inflection point. Second, I assume that those prior highs and lows will continue to act as support or resistance until they eventually may not. But I don't worry and say, oh, that old high, we're getting close to it. Maybe I shouldn't short the stock because it might break through it. Maybe it will, but maybe it won't. And if it doesn't, and you talk yourself out of shorting against resistance simply because you were afraid that it might get through resistance, then you've missed out on an opportunity that presented itself very clearly to you, that it's only your head that talked you out of it, out of fear. I assume those important levels from the past, just like even if we think about that gold chart that I had up before, the prior highs stayed the highs. Yes, it could break out. What's the worst thing that happened if I sold out of my gold near all-time highs and it broke out higher? What's the worst thing that happens? I buy it back and I pay a higher price than I sold it for. So what? If it's the right thing to do, if it breaks out and it's a clean breakout and I think it's going higher, all right, so I gave up $20, $30 in gold of opportunity cost. But if I didn't sell near the highs like I recently did, I've now given up $100 of price movement and I'm still stuck with longs not knowing what to do with them. Number 3, I look for signs that the crowd is giddy, that every Tom, Dick, and Harriet out there that needed to buy the name is already in. And that's not always the easiest thing to determine, but hey, just turn on CNBC or Bloomberg or any of these business channels, see how often they're talking about something. Look how often NVIDIA is being spoken about these days. And in the last month, how often NVIDIA has been spoken about. So certainly it shot up, and after its earnings, a spectacular earnings call, the price went from 300 to 400 in a week. Incredible, right? Who still needs to buy NVIDIA? Who has to buy NVIDIA? What short hasn't already gotten forced out that I'm going to go pay $400 a share to first get long now? So I put out a note to clients the day that it made its high of why I am selling covered calls and or reducing actual long exposure at $417 a share, a target I had in place since December of 2018. I look for indicators that tell me that the risk of now first buying into a sustained rally or now first selling into a sustained decline is very high. In other words, if something's been rocking to the upside, I'm using indicators that would tell me that this is not the time or place to be a buyer. Doesn't mean I might not buy a pullback, but it tells me right here and now, the risk is extraordinarily high to first play in the direction of the trend. So let me show you an example of an indicator like bullet point number 4. Here's a history. We're going to go back in time to the total trading history of Netflix, going back to when it went public here in 2002. And I have a particular model laid on top of this that was designed by the legendary model designer Tom DeMark. Now, this is a proprietary model of his. You do not have access to this unless you pay for access to this model. Let me show you just very simply. I'm not going to go through all the math, but let me just show you. There's kind of blue numbers and dark purple numbers on the chart. The blue numbers are called the setup. In this case of a week, this is a monthly chart. Each month that has a number above it in blue, or if we see in the future a number beneath it in blue, is a month that the closing price is higher than the closing price from 4 months prior. So each one of these months, starting in January 2003, this was month 1. And if you look back, 1, 2, 3, 4, this had the first time that you had a close above the close from 4 months prior. In February of that year, same thing. This monthly close was above the close from 4 prior. When you get to 9, what DeMark realized 40 years ago is that you've moved enough in one direction to say you potentially have trend. It's like real definable, mathematically showing up as a trend. After you get to 9, the model changes how it counts and labels what suffices as a requirement to ultimately get to a 13 count. And when it gets to its 13th bar of a particular relationship, you'll notice here bar 6, it took months to get to bar 7. When it hits 13, it often tells you that you have exhaustion of trend. So in this case, it's identifying in the late summer of 2005 that the trend is exhausting itself to the upside, that first buying at that time and place has inordinate high risk relative to what you could face if it sold off. So this is telling me that in this area, it's very risky to be a buyer, even though the highs were up here well higher and that this could certainly go higher. It also, a few months later, did another 9 count. And often, in this case, it didn't happen, but often we'll see a 9 count stall a trend for a few months. The ultimate signal here is the 13. but sometimes we're going to see that 9 counts can be helpful themselves. So this is telling you now, for what ends up being approximately 2 years, that buying up at the $4 level in Netflix had high risk to it. And you'll notice that this ended up going from 4 down to 2.5. Percentage-wise, while that signal was still active, very percentage-wise solid pullback. Now, this 9 count also gives it the ability to count again to a 13, which showed up in early 2008, telling you inordinately high risk relative, in other words, buying here has inordinately high risk to it. And sure enough, stock pulls back in 2008, bottoms before the whole market does in 2009. Remember, March 2009 was the bottom for most stocks, but this happened to bottom ultimately here, and then turns around and goes higher. Let's get to the next chart. So we're picking it up from here. Now we do another 9 count into 2010. Again, 9 months in a row that the closing price on the last day of the month was above the closing price from 4 months prior. We stall for a few months, but this leads to a massive rally. Tells me up here, again, buying deep in the trend. And this is why I showed you the charts that I did at the beginning when I said, if you bought up here, where would you stop yourself out? Remember, we said in the NVIDIA chart, we did a meta chart, we did a gold chart. How do you know when you're buying deep in a trend that you're actually getting in at the right time and place? Well, this is one of the models that helps me determine when not to be a buyer in the uptrend, when not to be a seller in a downtrend. 2011, the stock falls apart. Just 2 months after, makes a higher high and then collapses. And we get into 2000, we finally bottom, get into 2013, do a 9 count. We just keep extending past the 9 count. We're going to look for a 13. That ends up coming here in 2014. Exhaustion of trend. Doesn't mean it can't go higher. Tells me that the risk is inordinately high of buying in the uptrend. Now, where would most people are going to be getting long in here because you've broken out to new highs and you've taken out the prior 2011 highs. This is telling me a few months later, high risk, pulls back, holds support, does another 9 count to the upside, 9 months in a row, close above the close from 4 months prior, gets to 2015, telling me fairly high risk here. This, instead of going sideways for a couple bars, this goes sideways for 8 months. That takes us to this part of the chart. We do another 9 count. From the 9 count, you go a little higher, sideways for months. We get a 13. Look what happens after the 13 count. Boom. Percentage-wise, this goes from 375 to almost 2.25. $150 pullback. Huge. Eventually turns around, does a 9 count. That's into 2020. That's this. And now this is the picture since. So this is one of the models that helps give me a huge edge because it has me often selling when other people are buying and buying when other people are selling. It goes against everything you're taught, which is to play with the trend. And I'll play the trend until I can identify that a trend is exhausting itself. The problem with something like RSI, when you have a strong trend, is RSI will get overbought, and the initial reaction by most people is to sell out when RSI is overbought. And you get out, and for a week you feel like a hero, and then your stock doubles in price over the next 4 months, and you've left everything on the table because you got out just because RSI got overbought. Here, I'll give you a tip. I'll tell you that some people know, but very few people trade off of. When your RSI gets overbought in a strongly trending market, it's often the best time to be a buyer. Let that sit in for a bit. And go look at your charts when you have time after this and take a look at how many times RSI got overbought that you got out of and you were right for a bar or two and wrong for the bigger picture. RSI is only truly helpful in a sideways market. But when you have a strong trend, Getting out of something simply because it's overbought is not the right way of approaching it. Look at Honey. So this was a monthly chart that we looked at. I took you through the whole history of Netflix. Look at a daily chart of Honeywell. I mean, this is a Dow Jones name, right? So I didn't pick some strange name. Upside exhaustion, downside exhaustion, upside exhaustion, downside exhaustion. And this is through yesterday. Look at Apple on a 5-minute chart over the last 3 days, not including today, because I put this together late last night. 13 high, 13 bottom, 9 bottom, 9 minor high, 13 high. Yeah, you're not going to make nearly as much money. It's a 5-minute chart. So maximum, if you actually sold the high up here at 185 or so and bought it back at 177 and a half, I mean, it was fantastic, and you did it in virtually a day. But I showed you this to show you how robust this model is. This is not something that, only worked on those long-term charts. I can trade very short-term with this model too. So the reports I mentioned, and we're going to wrap up now, and we'll get to questions. I have the weekly tactical trader report, comes out Thursdays, and gives you a whole background on everything that affects the market. The stock market, does a deep dive in the S&P, and then gives you a brand new ETF idea each week, as well as walks you through every open trade we have until we get closed out of the trade. The monthly 7-11 report, that's the one designed to beat the S&P. That is handily beating the return of the spiders over the last 3 years. And what I wanted to announce is coming later this month, I am going to do, based upon requests of so many people who are begging me for this for some time now, I am going to start a third publication, a brand new report designed specifically for traders. There is not going to be, I can tell you, there is no other report out there that the public can access that will be anything like this upcoming service. So if you want to find out more, follow me on Twitter. My handle on Twitter is the same thing. It's In the Know Trader. So at In the Know Trader. What I want you to know is that you can subscribe to my reports. You can go month to month, or you can sign up for an annual subscription, but you get a very deeply discounted price of close to 20-25%, if I remember, when you sign up for a full year in advance. If you sign up for 2 reports that I have both, you get an even deeper discount. And I'm about to launch report number 3. If you get all 3 reports, you will have a significantly deep discount. And again, when you sign up for annuals, you get even more discount. So that's what I wanted to present to you today, mostly because very few people out there understand the concept of buying low and selling high. We all think of that in the head, and we think that we know, of course, buy low, sell high, but very, very few people do it. And the proof is in the pudding that 98% of the portfolio managers out there cannot beat the S&P. So some thoughts for you to walk away with from today. Sherry, I'll turn it back to you.
All right, well, right this second, and I wanted to remember to do it, we are going to get everyone in the room to enter a number between 1 and 100. And the first person, now I would like for you, Rick, to pick a number, but don't say it.
Mm-hmm.
And the first person who picks the right number or the closest number will be the person who gets your autographed book, which is, let me just see.
It's called New Thinking and Technical Analysis, Trading Models from the Masters.
Nice.
So I created a book for Bloomberg Press years ago that I went to who I thought were the top technicians and model designers at the time to each contribute for me a chapter on their best model. So this is a compilation book of some of the best models out there. And I edited the book and, put the whole thing together. And
Nice.
I will send a signed copy to our winner.
All right. Do you have a number?
I do.
All right, guys, I'm going to count it down for you. Everybody get your numbers in. I'm going to count backwards from 5, and then we're going to cut off the numbers at entering. And then, like I said, the first person who entered the right number will be the person who gets it. And then we'll get your email address, and then I will connect you with Rick, and then he will get that book sent to you. So 5, 4, 3, 2, 1. That's it. All right. What was the number, Rick?
68 for standard deviation of price activity.
All right. I'm scrolling.
I see
I have a 66.
I see I see a 66. I see another 66.
There was a 69 and another 66. So the first 66 was Randy. Randy, I need you to privately send me your email address. I could probably look you up, but I'd rather have it straight from you so that I can now send you and Rick an email and connect you together. And then that way we can keep track of who got what and make sure that everything's on the up and up. Sound good? And I
Sounds good.
also, I posted your Twitter handle at In the Know, or In the Know Trader, right? At In the Know Trader.
Correct.
And I also posted your website, www.intheknowtrader.com. And I also posted, it's Rick at intheknowtrader.com. So you guys can get in touch with him as you need to. And Randy, just send it to support@tradersexclusive.com. And I will reply to you, and I will get you together with Rick. Thank you so much. First one of the day. And I really appreciate you being willing to contribute a prize. And we do have a prize to award from our first speaker, but we're going to do that at another time, maybe when he can get back on here with us, since we didn't do it while he was here. So thank you so much, Rick. I appreciate you being with us. You guys, just watch your email, because everybody's going to be following up with you, and everyone will be following up ethically. You will not be spammed, or they will not be invited back to our event, because that's how we roll. And I hope you have a wonderful day, Rick, and I hope you'll think about coming back again in the future.
Sure, Sherry, my pleasure. And thanks everyone for tuning in.
Thank you. Have a good day now.
Bye-bye.
Let's see. Bye-bye.